Okay, in this video, we're going to look at some of the economics behind a bond, and we're going to talk about the disclosures of different companies and what you might see in their financial statements related to the bond. So we'll talk about how do investors value a bond. We'll go through a Nike example where a bond was issued at a discount. What do we see in Nike's financial statements with regard to that bond? We'll also go through a Bed Bath & Beyond bond, and those were issued at par, and we'll see what that looks like. Finally, we'll talk about how the fair value or the market price of a bond fluctuates subsequent to its issuance. Accountants don't really care too much about it. It's a supplemental disclosure that accountants will give to their investors, but the accounting for a bond is really locked in at issuance. So we will talk about the fluctuation in market prices after a company issues a bond, but it doesn't matter too much to the accountants of the company. So let's remember again, when a company issues a bond, it's because investors are willing to invest in the company in return for the company's promise to repay that money with interest. And so that is a debt investment. So let's imagine this boosted bond, okay? This is a company that was actually real. They made electric skateboards, and I think they went bankrupt. And so you probably shouldn't have invested in this bond. But here's the bond let's imagine they were offering. The issuance date of January 1st, 2018, a term of 3 years, $100,000 face value, a 5% coupon rate to be paid annually. And in terms of the economics, what do investors do is they look at the terms of this bond and they convert it into a schedule of expected cash flows. As long as the company stays non-bankrupt and follows through with the terms of the bond, what cash flows can an investor expect to get? Well, they can expect to get $5,000 or 5% of $100,000 coupon payments each year that goes by during the 3-year term of the bond. So here we see $5,000 each year during the term of the bond. And then in the final year of the bond, they expect to receive face value as a lump sum payment at the maturity date of the bond, which is why investors would expect $105,000 in that final year. And what they will do is, okay, these are 3 future cash payments that you would expect to get as an investor, and you're just going to discount those using the present value formula to figure out what is this bond worth to me today? What should I be willing to pay the company in return for this contract? So here's a Nike example. You can see that they're offering a face value. This is right on the face of this prospectus supplement form filed with the SEC. And the face value of this bond is $500 million. Nike is raising some capital, and they're offering a face value of $500 million. They're offering a coupon rate of 3.375%, which they talk about a little bit in this paragraph down below. And that's the coupon rate. So each year that goes by, they will multiply the face value times the coupon rate, and that will be the coupon payment that investors should expect to receive each year that goes by. And finally, we have the maturity date. This bond is expected to mature in 2046. And so it was issued in 2016, okay? So 2016, 2026, 2036, 2046. This is a 30-year bond that Nike is issuing. They want to borrow this money for 30 years while they make coupon payments each year that goes by. Okay, so if we just scroll down in this prospectus, what will we see? Well, we'll see all the banks, responsible for trying to figure out who's going to be willing to buy these bonds and kind of organizing the back end of this bond issuance. And we'll see that when they issue the bond, Nike gets proceeds, okay? So the proceeds to Nike, when they issue this $500 million bond, they get $490 million as proceeds. So they are issuing this bond at a discount, okay? They're getting less than face value on the issuance of this bond. And so those proceeds, when Nike issues the bond, they're going to debit cash for those proceeds, $490 million, and they'll credit the debt account for $490 million. Okay, moving now to Nike's debt footnote, we can see that this isn't the first time that they're issuing bonds, okay? They've issued bonds many times in the past. This is the one we just saw in the prospectus supplement. This had an original principal. Principal is another word for face value of $500 million. So this is dollars in millions. Okay, so that's $500 million face value or principal. This total long-term debt here, these numbers, we're going to be able to agree these to the balance sheet. So this is, what I'm showing you now is the footnote. But when you total up all of these amounts, you get a total of 3470. Current amount is 6 million, and non-current amount is 3464. Okay, and you'll be able to agree those amounts to the balance sheet, just to know that we're working with book values in this column here, and in this column here. So these, the 2019 and 2018 columns are the book values of the bond. They also say it at the top. And just basically, what do we observe? Well, when the company issued the bond, it was for a discount, right? The company received 490 million. And that will be, in 2016, the opening book value of that bond. And so back here in 2016, this used to say 490 million, okay? Back in 2016, that was the opening book value of the bond. And as the years go by, okay, this book value increases towards face value. And so you can see in the disclosure of Nike here, this book value of 490 is increasing. And it's getting closer and closer, and it will, over 30 years, it will eventually get up to face value over the 30 years of this bond's life. Okay, so that's what we observe in the footnote for Nike for this particular bond. Now let's look at a Bed Bath & Beyond bond. Again, we're looking at a prospectus supplement. If you're interested in finding these on the SEC's website, you'll want to look for Form 424B2 or B4. Okay, so this prospectus supplement is dated during 2014. That's when Bed Bath & Beyond issued these bonds. And they're issuing, in this one time period, they're issuing 3 tranches of bond. They're issuing $300 million of 3.749 coupon rate bonds, $300 million of 4.915 coupon rate bonds, and $900 million of 5.165% coupon rate bonds. And these bonds are going to come due at different time periods. So these bonds have different terms. It's 2014 when they're issuing the bond. So the first 300 million is going to come due in 2024, 10 years from then. The next one's going to come due in 2034, which is 20 years, and 2044, which is 30 years. So a 10-year, a 20-year, and a 30-year bond. It's got a $1.5 billion aggregate face value. And actually, Bed Bath & Beyond issued these bonds at par. So these coupon rates represented investors' required rates of return. It represented the effective interest rate at the time of issuance for these bonds. And these increase as the term of the bond gets longer because it's a riskier prospect to invest in a company for a longer period of time. They might go bankrupt. I mean, imagine Bed Bath & Beyond is kind of struggling recently. If you go into the store, there's not really very many people there. And Bed Bath & Beyond has been struggling to generate enough sales to justify their brick and mortar stores. And so it's a kind of a risky prospect to think of loaning Bed Bath & Beyond money for 30 years. Are they really going to survive for 30 more years? And that's the intuition behind why you might observe this required rate of return increasing as the bond's term increases. But for accounting purposes, these bonds were issued at par. So if we look at the statement of cash flows for Bed Bath & Beyond during this period, well, if they're issuing 1.5 billion aggregate face value of bonds at par, that ought to be the amount that they receive when they issue the bonds. And it is. So they have proceeds from the issuance of senior unsecured notes of $1.5 billion there during that the period of time that they issued that bond. And that right there we're observing is a debit to cash. That's what we observe there. If you were to look at the balance sheet, which we'll do next, we'll observe the credit to the debt account in the balance sheet. So here's their balance sheet from this is before they issued the bond, and this is after. August 30th, 2014 is just after they issued these bonds. You can see that the long-term debt account went from 0 to 1.5 billion. And what we're observing there is the credit balance in the long-term debt account, and it's at face value, so it won't need to amortize anywhere. In fact, if I put the future years balance sheet into this slide, so here we have February 28th, 2015, February 27th, 2016, you'll see that year after year, this bond's book value is just equal to its face value. And so it's not amortizing anywhere because it's already at face value. Okay, now I want to talk about what happens to a bond when it's trading in the market. So accountants we saw on the balance sheet and the statement of cash flows how the accountants are accounting for this bond. But As time passes, investors will change their assessment of how risky Bed Bath & Beyond is. And so investors are continually updating their effective interest rates. And generally, the way you can think of an effective interest rate is having two components to it. The first component is a risk-free rate, and the second component is a risk premium. The risk-free rate component is what is just the cost of borrowing, ignoring all risk. And the way we usually calculate this is by using the government's treasury rate. Because if you lend money to the government, you are almost guaranteed that the government will not go bankrupt, okay? The government can print money to satisfy its coupon payments. And so the amount of return that investors require to invest in government securities, we think of as the risk-free rate, okay? What do I charge for somebody using my money for a period of time? And then we add on top of that, since this is Bed Bath & Beyond, Bed Bath & Beyond can't print money, okay? And so we need to add on top of that for Bed Bath & Beyond a risk premium. And the question that this section answers is how much more risky is Bed Bath & Beyond than the US government? And that would be Bed Bath & Beyond's risk premium. And so investors are constantly changing their assessments of these two elements, right? The risk-free rate changes due to government policy, and the risk premium changes due to the particular risks of the company of interest, okay? And when we add these two components up, we get the total effective interest rate that investors are using to price the future cash flows of the bond. And since the effective interest rate is in the denominator of the present value formula, this orange box tells you the relation between the effective interest rate and the actual price that you should observe in the marketplace for the bond. What's the bond worth, okay? As the effective interest rate increases, the bond's market value decreases. So as investors need, a way to think about that is if I'm an investor and I need a higher rate of return, well, one way I can accomplish that, since the future cash flows are set in stone by the bond contract, the only way I can increase my rate of return is by paying less now and receiving the same cash flows in the future. That's how I increase my rate of return, okay? And so as I need a larger rate of return, I'm gonna pay less now for those same future cash flows. So as my effective interest rate goes up, the market value or the amount that investors are willing to pay decreases. And let's see what happens for Bed Bath & Beyond here. So the orange line I have is just the single bond that comes due in 2046, 2043, 2044, something like that, okay? And that was a $900 million face value bond. And that's the orange line there. And that bond was issued at par. And so this orange line is the bond's book value. It's on the balance sheet, and it doesn't need to amortize up or down towards its face value, okay? It's just flat at 900 million for the entire term of the bond. The blue line, on the other hand, is the market value. So if you logged into your E-Trade account and you wanted to buy some of this bond, the blue line tells you how much you would have to spend to invest in this bond, okay? Now, at the issuance date of the bond, the orange line and the blue line were equal because the company issued the bond at par. So at the issuance date, investors were willing to pay exactly $900 million for this bond issuance. But the blue, as you can see, the blue line squiggles up and down throughout the future. That's because investors are constantly changing their assessment of what is the risk-free rate and what ought to be the risk premium applied to Bed Bath & Beyond. And you can see that shortly after Bed Bath & Beyond issued this bond, the blue line increased above the orange line. So the bond became more valuable after it was issued. The reason that is because the effective interest rate at this point in time, the effective interest rate must have decreased from what it was at issuance. Remember, the value of the bond, the blue line, is the discounted present value of the future cash flows of the bond. And so if that amount goes up, the only way to accomplish that, since the cash flows are set in stone, is to decrease the effective interest rate in the bond. So we could say either, subsequent to this bond, at this point in time, one of two things or both have occurred. Either the risk-free rate has gone down since issuance, or the company itself, the risk premium, has decreased since the issuance of this bond. Now, looking at another point in time down here, the blue line now is below the orange line. So now the bond's market value is lower than its book value. Here we can say the opposite has occurred. The effective interest rate at this point now must be greater than what the effective interest rate was at issuance. And so either we could say the risk-free rate has gone up since issuance, or the risk premium has gone up since issuance, or both. And then we can kind of tie this into our intuition for what happened to Bed Bath & Beyond. Remember that we had the COVID-19 pandemic in early 2020. And what happened then was the economy shut down and nobody could go into the Bed Bath & Beyond stores anymore. So as you can imagine, when investors learned that Bed Bath & Beyond stores were closed, well, now those bonds become much more risky, because the question is, how is Bed Bath & Beyond going to be able to afford to make coupon payments and the maturity value payment? And so the riskiness of Bed Bath & Beyond, probably the risk premium, increased substantially in early 2020. And that increase in the risk premium made the market value of these bonds decrease very significantly, okay, right at the inception of the pandemic. And something interesting that happened during the pandemic is when people were spending a lot of time at home, they actually were spending more money than was expected at Bed Bath & Beyond stores because they were fixing up their homes, making their homes a nicer place to be. So they actually had some pretty good performance during the pandemic that was unexpected. And that caused the risk premium of Bed Bath & Beyond bonds to decrease slightly during the pandemic, and therefore the market value increased throughout the pandemic. But then again, recently Bed Bath & Beyond has had some real struggles and their market value has declined yet again. Okay, so that's just kind of the lifespan so far of the Bed Bath & Beyond bond. So in this video, we learned that the company sets the terms of a bond, and then the investors convert those terms of the bond into a schedule of future cash flows that they expect, and then they discount those future cash flows to come up with what the bond is worth at any given point in time. Accountants use the effective interest rate, but they only care about the effective interest rate that was in place at the date of issuance. So they lock in that rate in the accounting for a bond, but investors are continually updating their effective interest rate over time. And so those are the key points of this video about the economics and the disclosure of a bond.